Hello, everyone, and welcome. We are looking at topic one. So, this is the lecture recording for topic one, which is the conceptual framework of financial reporting. So, our learning objectives for today are listed here. Feel free to take a look. So basically, we are looking at the reasons for the existence of your conceptual framework. What are the basic objectives of financial reporting? We'll be talking about qualitative characteristics, elements of financial statements, assumptions, principles, and constraints, and the ongoing evolution towards international accounting standards. So, getting right into it, we are first looking at the conceptual framework. Now, conceptual framework is a coherent system of interrelated objectives and fundamentals that are foundation of developing standards and rules. The conceptual framework basically is needed to create the standard based on established concepts to provide assistance in solving new and emerging practice problems, increase users' understandability of and the confidence of financial reporting, and to enhance the comparability amongst different companies. This is what our conceptual framework pyramid looks like. Okay, so right at the bottom, we have our fundamental principles. So these fundamental principles basically address the how or the implementation issues. Above that, right between in the middle of that sandwich or the pyramid, we have level two. The level two is the bridging between level one and three. So this is where your qualitative characteristics come into play for accounting, and we also focus on our elements of financial statements. We will be discussing each of that in detail in a few seconds here. And right at the top of your pyramid, which is your level one, is your objectives of financial reporting, which basically addresses the why, okay? The goals and the purposes of accounting and the why piece. So, effective January 1st, 2020, this is when the International Financial Reporting Standards came into play. Um, so, the we will be discussing the general purposes financial reporting, qualitative characteristics of useful information, financial statements and reporting entities, elements of these financial statements, what is recognition, derecognition, measurement, and disclosures and presentation, along with the capital concept and the capital maintenance. So the objectives of the financial statements, first and foremost, is to present useful information to the users. Now, these users could be your internal users or they could be your external users. At the end of the day, the idea is to be able to use the information presented in these financial statements for decision making. So looking at the qualitative characteristics of useful information, so your fundamental characteristics that comes into play is your relevance and representational faithfulness. Your enhancing characteristics on the other side are your comparability, verifiability, timeliness, and understandability. So you must have your fundamental characteristics. Anything over and above that, the enhancing characteristics are always nice to have. But at the least, your information has to be relevant and it has to have faithfulness. So, your relevance. Your relevance is the information that will make a change in decision making, in decision makers' decision. Okay, that information is relevant. Anything that would make a difference in how the decision maker is looking at the information or the final decision that they would make about this information. So it needs to have some predictive or feedback or confirmatory value. We also have a concept of materiality. Anything that is material enough to make a difference in decision makers' perspective should be included. Okay. Okay. Under the representational faithfulness, we talk about transparency. We are trying to represent the economic reality of the business. The information that is presented has to be complete. It should include all the pertinent details. We shouldn't be missing on anything We shouldn't exclude anything that is relevant. Okay, so that is completeness. Neutrality is the business has to ensure that they are not favoring one set of users over the other. Keep in mind the same financial statements are used by a variety of users, your creditors, CRA, your managers, internal, external, all the parties use the same set of financial statements. So the company has to be neutral when they are applying these policies procedures to ensure that they are not favoring one set of users over the other, right? Freedom from error, we want to make sure that the information represents faithfully. There is non there are no errors into that information. The information has to be reliable. Okay, and management must make the estimates or use judgment wherever it's needed. Comparability is making sure that the company is preparing their financial statements in the same order or in the same fashion with the same consistent application of accounting policies and procedures to enhance comparability from one year to the other or between companies in the same industry. Verifiability is when the information represented on your financial statement has to be verifiable. A very good example of that is your cash. So when the company says I had $10,000 in my cash account at the end of the year, they should be able to verify that information, usually through a bank statement. So that is just one example, but every information that goes on to your financial statement has to have verifiability. Somebody should be able to take that information back and trace it back. Timeliness, the information or the financial statements has to be presented in a timely fashion before it loses its ability to influence the decision makers' decisions. Okay. Keep in mind your financial reporting is after the fact anyway, so we want to make sure that the financial information gets out in a timely fashion while it is still useful. Understandability needs to anyone with a reasonable understanding of accounting standards and accounting information should be able to interpret the financial information on the financial statements. Okay, so we don't want our financial information or your statements to be overly complicated so that people are not able to understand it. So we don't want that. We want them to be simple, we want them to be understandable. Anyone with a reasonable understanding should be able to comprehend your statements. So, your fundamental qualitative characteristics. So, to ensure the information has relevance and it represents faithfulness, basically we follow three steps. One is we identify the economic event or a transaction. Then we identify the type of information that would be relevant and can be faithfully represented. And finally, step three is to assess whether the information is available. At this step, we always look at cost benefit. So your benefit has to outweigh the cost of receiving or getting that information. So now we are looking at our financial statements and their elements. So with regards to our financial statements, we are preparing four financial statements under ASPE or under IFRS. So IFRS is your International Financial Reporting Standard. ASPE is your accounting standard for private enterprises. So amongst both of those standards, we still prepare the same four set of financial statements. There are some fine differences. Say for example, under ASPE, we have income statement. Under IFRS, we call it statement of financial performance, or the company can prepare statement of profit and loss and statement of other comprehensive income. The concept of other comprehensive income or OCI does not exist under ASPE. It only exists under IFRS. Then we prepare our statement of Statement of financial position under IFRS. Under ASPE, this financial statement is called as balance sheet. We also prepare statement of changes in shareholders' equity under IFRS, and this statement is referred to as statement of retained earnings under ASPE. Your statement of cash flow under IFRS is cash flow statement under ASPE. We will be looking at fine differences when we look at transactions to see how they are differently treated under ASPE and IFRS. But this is on a very conceptual level with regards to the financial statements. Now, here, guys, keep in mind that topic 1 and topic 2 is primarily a review of the prerequisite courses. So this is not new information. So we will not be spending a whole lot of time on discussing this. Um, okay. Now, when it comes to the elements of your financial statements, basically there are 6 types. There is assets, liabilities, equity, which basically comes from your balance sheet if you're thinking in ASPE terms, or your statement of financial position if you're thinking in IFRS terms. And then we have our revenue or income, expenses, and finally gains or losses, which comes from your income statement or your statement of comprehensive income. So asset is something that the company owns. Okay. The company has the present economic resource. It has the right to use the asset. It has the ability to use the asset to generate revenue. Okay. So entity has the control over these resources. So the resources result from the past transaction or an event, something that has happened in past. It includes tangibles and as well as intangibles and contractual elements. Okay, so the conceptual framework defines an asset as a right as opposed to the physical asset. So the company has the right to use the asset. On the other hand, we have liabilities. Liabilities is something that you owe. Okay, you owe it to other parties. It is stemming from a past transaction. Okay, it could come from a contractual obligation, it could come from a statutory requirement, there could be a constructive obligation, okay, where the company has potential economic burden, or it could come from an equitable obligation which is arising from more of a moral or ethical consideration. Okay, now whenever your liabilities are settled, there will be outflow of resources. Your settlement of the liability will reduce your assets. Okay, and these obligations, as we said, are resulting from past transactions. So, if we know what the assets and liabilities are, the equity necessarily is the difference between those two. So, your equity is the net worth. Your assets minus your liability is your equity. It also represents ownership interest. Normally, this consists of shares, retained earnings, and under IFRS, we will also account for AOCI account, which is accumulated other comprehensive income. Okay, now when it comes to revenue and income, IFRS and ASPE defines it a little bit differently. Under IFRS, this is seen as the increases in asset or decreases in liability other than those relating to contributions from shareholders. Under ASPE, this is increases in economic resources which results from ordinary operations. Okay, so the revenue is the income, or the income revenue is the money that the company generates from its ongoing day-to-day operations. When the company is generating revenue, they also are incurring expenses in order to support these revenue streams. Okay, so under IFRS, the expenses are defined as decreases in assets or increases in liabilities other than those relating to contributions from shareholders. And under ASP, we define this as decreases in economic resources that result from ordinary revenue generating activities. Okay, so with regards to your gains and losses. So under IFRS, your revenues and gains are grouped together under income and expenses, and losses are grouped together under expenses. Under ASP, though, are increases and decreases in equity from equity's peripheral or incidental transactions, except revenue and expenses and owner's activity. Okay, so the way we look at gains and losses is your revenues and expenses comes from your day-to-day operating activities, whereas your gains and losses comes from your peripheral activities or incidental transactions, something where the volume of transactions is low or the recurrence of those transactions is low. You are not doing these transactions on a day-to-day basis. Okay, so let's say if you've sold a capital asset, any gains or losses on that capital asset is a peripheral or incidental transaction. It's not something that you do on a day-to-day basis. That brings us to comprehensive income. Once again, comprehensive income, this concept only exists under IFRS. It does not exist under ASPE. So comprehensive includes net income and other comprehensive income. We also call that as OCI. Now, the other comprehensive income, what goes into that piece, that includes all the changes in equity except for net income and owners' investments and distributions. And we will explore these concepts more as we go through the coverage. So coming down to our fundamental principles and constraints. Now, now this helps which, when, and how financial elements, events should be recognized or derecognized, measured, or presented. Okay, now they act as a guideline for developing rational responses to controversial situations or financial reporting issues. Now, foundational principles also include these assumptions. So, under the three broad categories of recognition, derecognition, measurement, and disclosure and presentation, we will be looking at each one of this. So, our economic, um, we will look at each one of this in the next slides here. So, when the company is presenting these assumptions and these fundamental and enhancing characteristics, it's not always possible to have all of them. So sometimes we might end up seeing the trade-offs between one qualitative characteristics that has to be sacrificed for other. Okay. Um, all right. Okay, so your cost benefit relationship in accounting, we always look at the cost benefit relationship. What that means is anytime we are looking at the cost, we need to be able to compare the benefit out of that. We would only implement the practices or the ideas if the benefit of receiving that information or implementing a change is higher than the cost we will spend on doing that. Okay, so your cost benefit analysis is an ongoing kind of a transaction that has to be evaluated all the time. Okay, so with regards to recognition and derecognition that we are looking at up there a couple of slides ago. So our financial statements, they need to meet, when we're looking at a transaction needs to meet a definition of an element. Element is your asset, liability, revenue, expenses, gains, losses. Those are your elements. So a definition has to meet an item has to meet a definition of element for it to be recognized or derecognized from the financial statements. Recognition is the process of bringing the information onto your financial statements, and derecognition is taking that information out of your financial statements. Okay, now they have to provide the user with the relevant information which faithfully represents the underlying transaction or event. Okay, now if there is significant uncertainty as to the existence of the measurement, or there is low probability of occurrence, the information wouldn't be useful as it is. Economic entity assumptions. Now, the economic entity means that we are able to identify a unit of accountability. That unit of accountability can be a company, it can be a division, it can be an individual, it can be a location, it can be a lot of different things. What we are looking at is just a unit of accountability. That does not mean it has to be a legal entity. It may be, it may not be. It's not needed to be a legal entity. Okay. So the legal entities can be merged into an economic entity for financial reporting purposes. And that is what we will talk about in consolidated financial statement, which is an advanced financial accounting course. So that's not covered in this intermediate financial accounting one, but that will be the advanced financial accounting course. Okay. Now, when we are looking at how to define the economic entity, we generally look at the element of control. Who has the control? Control is an important factor when we determine, um, how to consolidate these entities. Is this one economic entity or are there more? So the criteria that we look at under IFRS is having power over investee. So the company who controls is able to um, to have power over investees' decisions. Who should be on the board of directors? Who should be their vendors? Who should be the suppliers? Okay, so any and all sorts of decision-making powers lie with the controller. The exposure or the right to variable returns from the investment. Okay, and ability to use that power over investee to affect the amount of investors' return. Now, here we are talking about the existence of control. The existence of control is what determines how these entities will be reporting. The actual control may or may not be present. Okay, that's besides the point. Our defining criteria is tied to the presence of control. Under the ASPE environment, we look at the continuing power to determine strategic decisions without others, and we need to be demonstrate distinctly, can the entity be unilaterally dissolved by the company, and do others have more than 10% ownership interest? Okay, now the element of control is something good for you to know, but this is explored in much more detail in the advanced financial accounting course as we discussed. Then comes our revenue recognition. So our revenue recognition, now this is where we are going to find much differences. A lot of our time in accounting 315 will be spent talking about the revenue recognition criteria. So under ASPE, we are using the earnings approach. So the revenue is recognized when the risk and rewards have been transferred to the buyer or the earning process is substantially completed. You can measure the revenue and the collectibility is assured. So as long as the risk and rewards have transferred, there is measurability and collectibility is realizable. Then we consider the revenue to be earned. We recognize the revenue and off we go. Okay, so the revenue is realized when goods or services are exchanged for cash or claims to cash. So this is a fairly easy process under ASPE. Under IFRS, though, we refer to IFRS 15 for contract-based approach. This is where we talk about five-step approach to revenue recognition. The first step is to establish if there is an existence of a contract with the customer. The existence of a contract could be a verbal contract, it could be a written, or it could just be a handshake. Okay, it there could be variety of contracts out there. So first and foremost, we look at identifying the existence of the contract. Then we look at the identification of performance obligations. So what does the company have to do in order to recognize revenue or earn revenue? How many performance obligations are we looking at? Okay. Is their performance obligation just to sell the goods, or are they providing any supporting services past that point? Are they doing any implementation, for example? Okay. So that determines how many performance obligations are attached to a contract. Once we know the number of the performance obligations, then we determine a total transaction price. And finally, once we have the total transaction price, then step 4 is to marry step 2 and step 3. So we take the total transaction price and then prorate that between different performance obligations. And step 5 is to recognize revenue as and when those performance obligations are completed. Now, this is quite an extensive process, and we will be talking about this in the following chapters when we discuss revenue recognition. So, this will be discussed in much detail at that point. Matching principle. Now, again, all of this information is coming from your prerequisite courses. So this is more of a refresher or a reminder. So there is nothing new here. So with the matching principle is to match your expenses to your revenues. There has to be a cost and effect relationship. All right. So if the expenses benefit future periods and meet the definition of an asset, then it will be recorded as an asset. Now, how do we measure? Okay, so when we talk about the measurement, there is lots of uncertainty. When a value cannot be objectively measured, there is existence of uncertainty. Does the asset or the liability meet the recognition criteria? Outcome is uncertain. There is difficulty in determining future outflows and inflows. So, because of the accrual accounting, measuring any element of financial statement requires use of estimates. So, the companies, if you recall from your prior courses, let's say if you're talking about a capital asset, the companies estimate the useful life of their asset, or they estimate the residual value or the salvage value of those assets. So wherever the company needs to use estimates or use their professional judgment, then they should do that to the best of their abilities. Okay, so we need to determine the level of uncertainty that is acceptable for any recognition. We need to use appropriate measurement tools. We need to disclose sufficient information to indicate and describe the uncertainty. Right? So your financial statement users need to know what is the level of uncertainty that the business is facing, and that information has to be stated to them. Okay, whatever measurement basis we are using, we have to indicate that in the notes to your financial statement. Okay, so that basically supports your faithful representation as well as completeness of your financial information. All right, now in the past, we have always used the historical cost principle. Historical cost principle is you record your asset or your transaction at the historical cost. Whatever was the cost of the transaction at the time is how you're going to record that information. But the current values, we are using a fair value system, a value in use, and current cost. Periodicity assumption. Okay, remember we talked about the economic entity assumption. So, under the periodicity assumption, we want to make sure that we are representing our financial statement in a timeliness manner, in a fashion where they still can add value to decision makers' thinking process. Okay, it can add value in terms of being able to predict the future or to confirm their understanding, or a feedback value or confirmatory value, right? But that only holds true if the financial information is provided in a timely fashion. With regards to timeliness, we try to produce these financial statements on a certain period. It could be on a monthly basis, it could be on a quarterly, it could be on a yearly basis. That entirely depends on the business as to how often do they want to do this. Monetary unit assumption. Now, money is the most common unit of measurement when it comes to any economic transaction. Okay, so that because money is the most relevant unit, it is more understandable, it's universal, it's available, it's useful, it's something that we all understand and relate to. So, in Canadian and in US context, the dollar is assumed to remain relatively stable in the value. That means the inflation and deflation is ignored. Okay, now keep in mind though your monetary unit is only relevant as long as it is assumed that the qualitative characteristics are useful in communicating economic information. Going concern assumption. Now, this is an assumption that the business enterprises will continue to operate in foreseeable future. So that means they will continue being in the business year after year after year. So there is an expectation of continuing long enough so that the company can meet their objectives and their commitment. So the management must look at least 12 months from the balance sheet date. Okay, so although their long term objective is to be profitable and be into existence and be the best in the market, let's say, but they are looking at long term sustainability. But when we assess for the going concern assumption on a financial basis, we are considering 12 months from the balance sheet date. If there is any indication of liquidity of the company, then we will use to liquidation accounting, which is also called as net realizable value. So if we were to sell those assets today, how much would we get for those assets today? As an example, I'm using assets, but everything onto your financial statements will be brought onto liquidation accounting or net realizable value. Okay, so the full disclosure is required because this is a material transaction. Historical cost principle. Now, historical cost principle is what we were talking about just a few minutes earlier. So, this, uh, under the historical cost principle, we always look at the cash paid or the fair value of the initial transaction. So, your transaction is recorded at the original cost to you. So the initial recognition of non-financial assets, they're all recorded at cost incurred to get the asset ready for sale or for its intended use. Okay. Say, for example, if you are looking at, if you purchased a machine, you purchased the machine from a different province, you have to pay the cost of the machine, you have to pay moving charges, you have to pay installation, you have to pay some other setup charges. So all of that becomes the cost of your asset. So all of those together becomes The intended use for your asset is for that to produce your units. Let's say you're going to use this machine in manufacturing. So any cost that you incur up until that asset is ready for use, for intended use, does have the ability to be capitalized. So three basic assumptions when it comes to historical cost that we look at is to present a value at a point in time. It results from a reciprocal exchange, which is a two-way exchange. Something is coming in, something is going out, and the exchange includes an outside arm's length party, meaning that it is not with a related party. Okay, when we are looking at measurement of especially challenging for non-monetary transactions, non-monetary transactions are no cash or monetary consideration exchange. And we will explore more on the non-monetary transactions when we are looking at the capital asset sections. Non-monetary and non-reciprocal transactions, which is your donations. How do you determine the actual cost of the transaction when you're donating something? Or when you look at non-arm's length transactions, such as a transaction between related party, transactions between sister concerns where they do have the ability to discount or inflate the prices. So how do you come up with those costs? So usually with the historical cost principle, these are very common challenges. Okay, so in these situations, in order to address these challenges, one of the things that the company can do is to estimate the fair value of these transactions. It applies to short term financial instruments as well, such as bonds, notes, accounts payables, and receivables. Our fair value principle. So, under IFRS, our fair value principle is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Okay, so you have an entry price. Entry price is your purchase price, which at that point in time is or was your market price. Okay, now as the timeline moves, then you have your value in use as you're using the asset, which is your value to the entity. Value of that asset to the entity is value in use. And at the end, once that asset comes to the end of its life, or when the company decides to get rid of this asset, what is the exit price or the selling price? So that selling price then becomes fair value. All right. So under ASPE, amount of consideration that would be agreed upon in an arm's length transaction between knowledgeable, willing parties who are under no compulsion to act is considered as fair value. It does not refer to an orderly market, nor does it stipulate that the price is an exit price. So, a bit different approach under ASPE. Okay, so the under the fair value option, your financial instruments are measured at fair value with gain and losses that are booked to income. And we will explore this concept a little bit more when we look at our investment section towards the end of the course. So in the last half here, we are talking about our presentation and disclosure. So full disclosure principle is a requirement. It is not a choice. It's not something which is nice for the companies to do. It is a requirement. The companies have to go with the full disclosure principle. It's a general principle that has to be followed. Okay, so any information that is useful for the decision makers has to be disclosed. Any transaction that is relevant has to be disclosed. Anything that's material has to be disclosed. We need to provide sufficient details of the occurrence of the transactions, and there has to be sufficiently condensed to remain understandable and appropriate in terms of cost of preparing and using it. So the disclosures can be made with the main body of the within the main body of the financial statements. Alternatively, you can put the disclosures into the notes to your financial statements, or you can issue supplementary information such as your MD&As, also called as management discussions and analysis. It really depends on the company as to how they would like to abide by the full disclosure principle. Okay, just to give you a quick example, the full disclosure principle requires when you have an asset and you're depreciating the asset, you have to fully disclose the current value of the asset, the amortization schedule, and what is the depreciation method that you have used. That is full disclosure principle. Where would you show that information? Either on the body of your financial statement, which will make it really cumbersome here in this case, so likely into the notes to your financial statements. Companies, certain the companies following IFRS, International Financial Reporting Standards, tends to issue the MD&As or management discussions and analysis, but this is not a very common trend in ASPE companies. So it really depends on how the company wants to represent that information. Okay, so there is always a trade-off. Is there enough detail, or is there too detailed and it's not condensed enough? Full disclosure, as we said, is not a substitute for proper accounting practices. It's a requirement. Okay, so your notes to the financial statements are essential, and they should help the users understand the accounting practices of the business. So management discussions and analysis, the MD&As, this basically provides management's explanation or their view or analysis of the financial statements. So the six disclosure principles that they follow is to provide a view through management's eyes. What does management think? Management thinks of its performance in the reporting period. What are the supplements and complement information in the financial information? Does it provide fair, complete, and balanced information that is material to decision maker? Does it outline key trends, risk, uncertainties that may affect the company in the future and provide information on the quality of earnings and cash flow? Explain management's plan for long term as well as short term, and be understandable, relevant, comparable, verifiable, and in a timely manner. So, if the company is preparing management discussion and analysis, they have to make sure that all of these six rules are or the principles are applied. Further on to our MD&As. So under IFRS, there is a general trend towards increased disclosure to achieve greater transparency, but it's entirely up to the private companies if they want to issue MD&As, which is not a very common trend, but if they choose to, they can. So the five key elements that they need to touch on is the core business, the objectives of the business and what strategies they are applying, capability to deliver the results. How is the company going to deliver the results and the outlook into the future? Okay, the existing results that they are presenting and what the future for the company looks like, and their key performance measures and the indicators. So that provides enough information for the readers to be able to predict or make any useful decisions for this particular business. Evolution of accounting standards. So, rule based standards for financial engineering. So, under the US GAAP is more rule based than IFRS or ASPE. Okay, IFRS and ASPE, they are more principle based, whereas US GAAP is more rule based. The rules reduce the amount of the professional judgment that is required, but there are lots of rules to remember, apply, and be consistent with those. Okay, but they often promote financial engineering. Right now, legally structuring the transaction so that they can meet the company's financial reporting objectives while complying with GAAP is known as financial engineering. Okay, sometimes this is also called as creative accounting. Right, so basically what you're doing is, because we follow um, the principle based accounting system, or the rule or the financial standards, it does leave the room or the gray area for people to legally structure the transactions to get to a certain desired end result. Okay, that is what your financial engineering is. So your structured financing is creating instruments so the financial reporting objectives are within GAAP, and your financial engineering could result in biased information, where if you have biased information, then your neutrality principle is in violation. Fraudulent financial reporting. Um, Finat. Okay, this is where we're talking about the examples of Enron, WorldCom, Tyco. Okay, the companies, what did they do wrong? So when there's pressure for reaching specific financial reporting objectives are high, the risk of fraudulent financial transactions is also increased. Okay, if you have an end goal in mind and you're trying to get creative or um, go through financial engineering process, then the chances of fraudulent information is high. So the chances of economic or the business environment could trigger manipulation of financial information. The negative influence of budgets may lead to inappropriate decisions, and often the result of weak internal control and governance bring on the fraudulent financial reporting. Principle-based standards, your IFRS and ASPE are principle-based standard. They are grounded in the conceptual framework. What that means is we are selecting and interpreting accounting principles and rules, relies on application of professional judgment. Okay, so in IFRS and ASPE world, we end up using lots of professional judgment when these accounting principles are applied to transactions. There has been increasing moves towards the adoption or convergence to IFRS. Now, keep in mind the publicly traded companies have to follow international financial reporting standards. The private corporations have to follow accounting standards for private enterprises at the least, which is ASPE, but they do have a choice of adopting IFRS should they choose to. Okay, so the benefit of this approach is consistency and flexibility, and the standards are derived from first principles. So, in the absence of specific gap guidance, the policies should be developed through exercising professional judgment and applying the conceptual framework. Keep in mind, we come through newer transactions, more complicated financial transactions day in, day out. Okay, the financial world is getting more complex by the day. So, if you come across something that has not already been discussed, then we want to be able to look at our conceptual framework, look at our professional judgment, gap guiding principles, and then make a decision. Okay, and our final slide is the recent activities at IASB, the International Accounting Standard Board, which is responsible for setting IFRS standards. So, March 2018, they released a new conceptual framework, and they are working on a definition of materiality right now, how to apply materiality, and developing the framework for disclosures. So what's upcoming is primary financial statement project. That is all, folks, that we had for topic one to discuss. Once again, this is topic one for Accounting 315, the conceptual framework for financial reporting. Such things can show up for a multiple choice question, or we give you a bunch of transactions and you have to match them with the principles or the fundamental qualitative characteristics. We will be looking at examples in our live class, but this is all for the lesson on topic one. And this is me, Guru, signing off. Take care.